Thought leadership from PwC's National Office.
Hello, and welcome to PwC's Accounting Podcast. I'm Heather Horn. Today is the final episode of our year-end toolkit series, but also a great one to really kick off the rest of our year because it's an important topic for anyone involved in accounting and reporting, an update on new accounting standards. A new year, of course, means that there are new FASB standards effective. This year, they range from guidance on joint ventures to cryptocurrency to profit interest awards. In today's episode, we'll get you up to speed and provide an overview of the new standards. And, of course, don't forget that the impact of adopting new standards may also need to be disclosed in your 2024 financial statements. Back for today is Kyle Moffitt, PwC's National Office Professional Practice Group Leader and the guest host for the series. Kyle's joined by Jay Celeber, a partner in PwC's National Office who's been closely following the new guidance. With that, let's start the episode.
Hello and welcome to our podcast. Today we'll be talking about a number of accounting standards with upcoming effective dates in 2025. We've obviously covered a lot in our podcast over the last few weeks with respect to 2024. Interestingly, these standards cover a broad range of topics, and that's why I have Jay Celeber here with us today. Jay is a partner in the National Office who I consider, and I think many others consider to be a jack of all trades, pretty broad understanding of pretty much anything, and is always my go-to guy. Talks to a lot of clients and engages in a lot of CPE sessions, and so it's great to have you here. Perfect to have you to share with us kind of your thoughts on these various accounting standard updates. And you and I were talking just before this, where we were saying it's kind of a little bit all over the place, the topics, but I think certainly is worth spending a little bit of time on each of these. Certainly expect that these are going to impact companies moving forward. So to start, Jay, can you just provide a quick overview of some of the key standards effective in 2025 for calendar year-end companies, and which ones we plan on addressing today?
Sure. Well, first, thanks for having me here today, Kyle, and for the great introduction. I certainly appreciate the compliment. Today, we were planning to talk about four relatively newer standards in this podcast, and that's joint venture formation, cryptocurrency, profits interests, and investments in tax credit structures. And we'll get into what each of those mean. Those are some cryptic words in some cases, but we'll get into each of those as we go along here today. Maybe before getting into these, I would mention there's a few other standards that are effective in 2025 as well that we're not going to cover on this podcast. One of those is on long duration insurance contracts, which is a little bit more industry specific. So we're not going to talk about it in a broad approach here. And the other is improvement to income tax disclosures, but we've covered that in
multiple
some other
times,
podcasts,
right.
so we weren't going to talk about it again here. Probably maybe a good spot to plug here that on Viewpoint, we have a landing page that lists all of the effective dates of all of the guidance, kind of for both public and non-public entities, and links to the guidance itself and other resources we have. And we keep that updated. So it's a good resource, I think, for our listeners to keep up to date on when these new standards will be effective for them.
That's a great point, and we will include a link to that in the show notes. Why don't we dive in and start with the oldest of the bunch in our program today, and that is ASU 2023-05 on joint venture formations. I can tell you that I was happy to see that this was tackled by the FASB, and certainly interested in kind of what you have to say on the topic. Can you tell us a little bit more about this one?
Yeah, sure. Maybe I'll start with the scope because it is a little bit narrower than maybe people think. It only applies to the financial statements of the joint venture itself and only at the time of its formation. So it does not change any of the accounting or touch any of the accounting by the parties who contribute the assets into the joint venture, and it also doesn't cover any subsequent transactions between the parties after the initial formation of the JV. As you said, it was before this came out. There was no authoritative guidance in U.S. GAAP that addressed how a joint venture, when it got started, should recognize all the contributions it receives. And as a result of that, there had been diversity in practice, some of that driven by some SEC feedback as well, or perspectives. But many joint ventures accounted for the contributions they received at the carryover basis from the venturers, but others were reported at fair value. So the FASB took on this project to try to standardize that. And under this new guidance, a joint venture, when it's formed, it is going to be measuring all of the net assets that were contributed to the joint venture as of the formation date at new basis. Now, that sounds a lot like a business combination. The FASB was careful. It leverages that a lot. But they were careful not to call it a business combination or an acquisition or use any of that terminology, because by definition, in a joint venture, one side isn't getting control of the other, given the joint control that has to exist here. And the FASB didn't want to create any confusion in the overall models that we use for newcos that are part of a business combination. They didn't want to say, for example, that the newco that's formed is gaining control of both sides of the venture here, because that could create a lot of unintended consequences, perhaps, in the broader BizCom literature that we deal with. But that being said, the new guidance certainly leverages the business combinations guidance that we have. And so what I mean by that is that, for the most part, the net assets, when I said new basis, they're all coming over at fair value. But there's the same exceptions here that there are in the business combination literature for things like contingencies or leases or taxes, employee benefits, things like that. So those follow the same guidance.
Very familiar for people who've dealt with that before.
Yep, exactly. And the phrase formation date is also a defined phrase in here. And it's meant to be kind of similar to the acquisition date in the business combination. But again, they're not using the phrase acquisition date in my air quotes. I like my air quotes. Yep. But it's the relevant date that you would use to measure all of the contributed assets and liabilities.
That's great clarification, and obviously very important to understand some of the similarities and, of course, the differences from BizCom accounting. We also understand that guidance is limited in scope. So could you share with us who you think, because basically the industries that you think will most be affected by this change? I think one of the things, as an auditor years and years ago when I was, before I went to the SEC, spent a lot of time with, real estate companies or whatever. But what types of companies would we see this kind of impact, how it would play out?
Yeah, I mean, we do see joint ventures, obviously, across a lot of different industries. Of course, the trick here is that it has to be at a joint venture, more air quotes, for accounting purposes. We often hear business people bandy about the phrase joint venture all the time.
And I think that's a great point.
Right. And so everything is called a joint venture. When two or more parties are getting together to do something, everybody calls it a joint venture internally. But there's some specific definition of what a joint venture is for accounting purposes. And it has to meet all of those to be in the scope of this guidance. Right. So that's, there's joint control between the parties and all the key decisions that have to be made. All the parties are active participants. It's not just a financial investor, right? They're actively involved in it, generally operated for the mutual benefit of the companies or sharing risks or things like that. So anyways, there's some specific guidance to look to. But in terms of the industries, I mean, we see it in things like the energy industry has a share of it. The construction industry has a share of it. Sometimes in the pharma world, and maybe entities that have somewhat complementary drug compounds maybe are going to share some resources around it, and the technology sector as well. So it's I wouldn't say it's limited to specific industries. We do see it across different ones, but there's probably a lot fewer accounting joint ventures than what business people talk about as being a joint venture.
Right.
The other thing from a scope perspective that I said it before, but I'll highlight again, this does not change any of the accounting by the joint venture partners that are contributing the assets down into this business. They've probably lost control, or they have lost control or unilateral control of what they had before and now have joint control. So that's a fair value transaction where they've basically disposed of what they had and now have like an equity method investment to account for. So there is fair value information already out there. The FASB acknowledged that, hey, the companies doing these transactions generally have fair value information. But now this standard is going to require the joint venture to do more fair value stuff at a lower level, perhaps, and at a lower level of materiality, perhaps, than the venturers were doing. So there's definitely some incremental work that will perhaps come out of this standard as a result, because now the joint venture will have to fair value, with some exceptions, but generally fair value all of its assets and liabilities, which is going to be at a lower level and a lower level of materiality probably than the fair value of the whole entity that the venture partners were using before.
All right, look, I think that makes perfect sense. And obviously it's important to understand whose perspective the accounting is from, and whether it's the venturers or the JV entity itself. One thing that kind of popped in my head as you were going through that, it was just, okay, the venturer, right? Like, you're contributing assets, so they're, how do they think about impacts to reporting, right? Financial reporting impacts, SEC reporting. So it's definitely one thing where you have to look at both sides. And you can't ignore that there may be potential impacts or that could be material and may require other things to be considered and evaluated. As we look ahead, can you remind us just how and when this standard will be effective?
Right. So the standard did come out a year and a half ago or so. But it could be adopted by anyone at any time now anyways. But the required adoption date is it's effective prospectively for any joint ventures formed after January 1st, 2025. So it's a little different type of transition than most standards. It's not fiscal years beginning after a certain date. It's just sort of a universal single date for everybody.
Yep.
After January 1st, all new joint
Finally,
ventures
something
formed,
that's easy.
Yes, have to follow this new guidance.
Yep.
Now, if you have an existing joint venture or one that's formed before that date, really any date in the past, theoretically back decades if you wanted to, you could apply the new guidance retrospectively to it. But of course, that would mean you'd have to have all of that information in order to do what the calculations of what the balance is, ultimately to work to what the balances would be as of the date of adoption, as if you had always been following this guidance. So I don't know how many are going to go back retrospectively to do it. We don't hear too many of that. Frankly, we don't run into too many in our client base of actual joint ventures themselves. So, but for those that have it, it's certainly relevant. Part of what the FASB was trying to do here was create consistency, but also maybe perhaps eliminate or minimize the number of basis differences between the parties, which is a whole nother topic for another day, perhaps, about equity method basis differences. Yeah. But since, as we said, the investor is going to record this at fair value and always has had to record it at fair value, if the joint venture was recording stuff that's something other than fair value, you had all these basis differences to track. And part of the goal here was to try to reduce or
certainly simplifies it. Right. Definitely. So lastly on this topic, where can our listeners find more information?
So, we included discussion about this guidance in Chapter 6 of our Equity Method and Joint Ventures Guide. And I think we also put out an in-depth about this new guidance back in the latter half of 2023 when it came out. That's still up on our Viewpoint platform.
Right. Well, that was a great summary, and really appreciate you pointing us to those resources. Let's pivot now to an area that is definitely at the high end of interest, not just of our capital markets, but obviously of regulators, of the Trump administration, and that is crypto assets. And so there is an ASU 2023-08 on crypto assets. I know we've heard, and even back when I was at the SEC, a lot of conversations around the current accounting model isn't really, it's not necessarily desirable, and both preparers and investors had voiced doesn't really do a great job of reflecting the nature of the assets. And I think that was one of the things that we, when I was at the staff, that we talked a lot about. Could you give us a little background on what the accounting for crypto assets looks like today, and then the changes we'll see under the new guidance?
Right. And certainly, as we've seen in the marketplace recently, it's certainly yet another reason why the existing model maybe was not what made sense to a lot of investors. And that's because the existing model treats crypto assets as an indefinite lived intangible asset. Kind of doesn't fit into any other bucket of GAAP. So it ended up as an intangible asset with an indefinite life. And that, as our listeners probably know, follows a cost less impairment model. So you can write the assets down, but you can't write them back up, and you have to track any time during the period that they've gone down. You might have to impair them. So it was a one-way street, and people didn't love that answer because these things are pretty volatile as we're seeing, and a lot of companies argued that model didn't really reflect the economics of what was going on.
And disclosures in a filing that talk about what the current price may be on a given date, right, is really not always relevant. And by the way, it's just disclosure. You're not actually writing it back up. And so obviously very challenging, doesn't really give people insights as to economically truly what's happening.
Right. So that's what the FASB is trying to do here. And what the new guidance says is that while it doesn't change any of the initial recognition and measurement of crypto assets that you first receive, but what is changing is that crypto assets that are in the scope of this guidance will now be measured on a go-forward basis at fair value, with gains and losses from that remeasurement included in net income. So now you're basically writing them up and down through the P&L, in essence. There is a fair amount of separate presentation and disclosures in the new standard as well that kind of comes with trying to report all that. So you do have to separately present the crypto assets that are in the scope of the standard from other intangible assets. So you can't just lump them all together in intangible assets. And you have to separately present the remeasurement of those crypto assets on the income statement separately from any other amortization or impairment. So there's separate presentation requirements.
Right.
And then there's also a fair amount of incremental disclosures that will be required some on an annual, some on an interim basis as well, including listing out individual holdings and including some roll forward so investors can really understand what you have and what's changed during the period.
Yeah, I think as you think about it, we already talked a little bit about this, it's just the economics and it's obviously will lessen the impacts, when you get to the point where you're actually going to sell those assets down the line. And so I think kind of that volatility, you're certainly going to see it in moving forward once you adopt the standard. Look, I think this one is interesting because the FASB still thinks that these are intangible assets and not just a currency or cash equivalent. I mean, they don't want to start marking all intangible assets to fair value. So how do you know when you can and can't apply this new guidance? As you're going through this, I'm like, well, which crypto assets would fall into the scope? Bitcoin. What are you thinking there?
Right. No, and that's definitely one of the biggest challenges here. And the FASB is basically creating an exception to the general model that they thought made sense in the circumstances, but it's always hard to figure out the right scope of any exception that they're making here. And of course, further complicating that is that there's no universal or uniform definition of a crypto asset, sort of like joint venture, right? Everybody has their own way of describing it. So certainly the scope is pretty important. So at a pretty high level, to be in the scope of this guidance, the FASB said they first have to be an intangible asset. So that means they're not a financial asset like fiat currency or something like that, right? Obviously, people think of this as just a currency, right? It's a cryptocurrency, so people think of it as like a currency.
I can use it to pay for something. Isn't it a currency?
Right? It's no differently than holding, Japanese yen or euros or something like that. But they're not that, at least not at the moment, right? I guess we'll see where the world goes.
Where countries go with it. Yep.
Right. So it can't be a financial asset, and of course they lack physical substance. But then beyond that, they also have to be crypto assets that are on a distributed ledger, like a blockchain. They have to be fungible, meaning that there's nothing unique about this Bitcoin versus that Bitcoin or whatever currency you're talking about. And they also can't give the holder any specific rights or claims to goods or services. Meaning, in other words, they can't be a utility token, which we see a lot of companies issue, right? Where you hold a token or the crypto asset, and that gives you the right to something from them in the future. It can't be those. It has to be something that isn't related to that. And it also can't be something that's created by the company itself or one of its related parties, since we've seen a lot of those as well, right? Where a company kind of creates its own coins. Well, those don't work. One area that's a little tricky, and it's probably beyond the scope of this podcast, is the notion of wrapped tokens, because the guidance would say you have to really understand these wrapped tokens, because the wrapped tokens give their holders the rights to other assets, including other tokens. And so since the guidance says that you're not in scope if what you hold is giving you the right to some other asset, it might suggest that these wrap tokens are not in scope, and that's still an area that's a little bit challenging for folks. So I would say if you have that, it would probably be good to look into the detailed scope discussion that we have in our crypto guide as well as the standard itself. One thing I would say that maybe is a surprise to folks is that unlike some other bits of accounting literature, One thing that's not in the scoping requirements here is whether the particular crypto asset has a quoted price or trades in an active market. There's no practical expedient for not measuring it at fair value just because you can't readily determine the price of it. So if it's in scope, but it doesn't have a quoted price, you still have to go figure out fair value each period, like any other thing that you have to figure out a fair value for. So that's interesting. You don't get a scope out for it like you do for like investments in an equity of a company that's not public. You might have certain practical expedients. You don't get that same practical expedient here.
Right. Look, that's an interesting point. Well, one question that popped up as you were kind of going through all that is situations where a company does register a token. And let's say it's something that they register with the SEC, it's traded on an exchange. If you are investing in that token, what guidance would be applicable to those situations? Are you just looking and saying this is just like any other investment security and you're going to account for it under the relevant guidance?
So if you've created your own token?
So you created when a company creates its own token, right? They have their coin offering. They used to call them initial coin offerings, right? And they register with the SEC, they start trading, and then another company comes in and invests in those tokens. Where does that fall? I mean, it seems like it wouldn't be subject to this guidance, right? It seems like it would be a security. The SEC is recognizing it as a security. Like, has that been something that's been discussed?
Yeah, well, I guess, from the company that created it, it certainly wouldn't be in the scope of this guidance.
Right.
For a company that purchases it, I guess you'd have to look back to the scope of it, and including the one that it's on a distributed ledger like a blockchain.
Yep.
So
I
don't know if it is or it isn't.
Right,
and every one of those is different, right? They're unique white papers or so, but there's probably a good
I'm not sure there's a lot of
not.
companies that are investing in another company's tokens, but
I think you'd have to look at the scope. I mean, my sense is that they might not meet the scope, but I think that every one of those was very bespoke. And on white papers and the like as to what does that entail. And maybe the token gives you the right to some goods or services from that company. Right. We certainly saw a lot of initial coin offerings that
fell in that bucket.
Right. That bucket of it gives the holder of those tokens the right to get something from the company at a discount in the future. Those would not be in scope because that's one of the criteria. And if it's not on a blockchain, it would not be in scope. And so if it's not, then I guess they would still be in their existing model of it's an indefinite lived intangible asset, or maybe it's a service or a prepaid service, right? If it's some type of utility token, then it might be the right to a future service or something like that. So you got to go through all the things you go through when you make those investments.
So you previously raised an important consideration about the amount of incremental disclosure that will be required, and kind of had me thinking about what that might look like. And you start to think about, the thousands of crypto-related transactions that may occur in a period. It's a good reminder to preparers that they really need to rely on and be ready from a data perspective to gather the information required to measure and disclose their crypto holdings. And so really highlights to me kind of the importance of controls and effective control environment. So Jay, with all of that in mind, can you share when this standard will be effective?
Soon. It's effective for all companies, both public and non-public, in fiscal years beginning after December 15th, 2024, and including the interim periods in those years. So that would mean if you're a calendar year public company or any, public company because you'll be doing interims, but a calendar year company, it means you're adopting it in Q1 of 25, right now as we're sitting here right now. So basically, if you don't have that data, ability to gather that data, you better figure it out soon, I guess. And this is one that is adopted via a cumulative effect adjustment to retained earnings as of the beginning of the year of adoption. So it's a modified retrospective application. You have to go back to the prior years. You can't go back to the prior years.
But it makes sense.
But
it makes sense.
Sort of cut over as of the date of adoption.
Yep. So where can listeners find more information on this topic?
Well, this one we have a whole guide dedicated to crypto assets. And this new guidance is interspersed throughout it, although a lot of the accounting discussions in Chapter 2 and the disclosure requirements are in Chapter 5. And like the last one, we also still have an in-depth outstanding on our
which is
on the viewpoint.
Which is a very good in-depth that I highly recommend.
Excellent.
Did you write that?
I did not. I can't take credit for that one.
You take credit for that one. It's
but
a
my
great
team
in-depth.
did, so that's good.
Yeah, absolutely. So let's move on to another kind of complex instrument that's covered in ASU 2024-01, and that's the scope application of profits, interests, and similar words in stock compensation literature. Our listeners may be thinking, what in the world is a profits interest? So can you talk a little bit about what that is?
Well, whatever it is, it sounds like I'd like one.
Yeah, absolutely.
I'll get to that, I promise. But maybe before getting to that, maybe let's give a little backdrop in that about the compensation literature, because what we have guidance in the stock-based compensation literature for those kinds of awards. And then we have separate guidance for just cash payments that might be viewed as more like deferred compensation or bonuses. So there's so ultimately this is about a scope question, I guess, as the name implies. And what's challenging is that the stock compensation guidance that's in ASC 718 is written in the context of a more traditional C corporation where with stock, regular old common stock, and the holders getting either restricted stock awards or stock options, right? That's the general premise in all the examples in there. So it's written in that kind of context. But of course, as we all know, more and more companies are being established as other kinds of legal entities like limited liability corporations or LLCs or limited partnerships. And those entities have a lot of more flexibility in what their capital accounts might look like. And they may issue many different kinds of arrangements to their employees and service providers to let them share in the upside of the entity. And one of those items, tying into your question of what this is, one of those items is called a profits interest, often in an LLC type of agreement. And what it does is it gives the holder the right to share in the future profits and appreciation of the assets of the entity, but not any right to the net assets at the time it's granted. So usually the way that's works itself out is that the instrument, the profits instrument, doesn't start to participate in any distributions of the entity or liquidation proceeds of the entity until the other investors have first received back a stated amount, which is usually the value at the time of the grant.
Yep. Well, that makes sense. I mean, obviously sounds like a complex structure that's kind of like a stock appreciation, right?
Yeah, it is. It does economically behave a lot like that, and I think ultimately it's valued like that if you do have to value it. But it's not something that's defined in GAAP. That's the challenge. But it is defined in the tax code, and that's kind of where this comes out of. And the reason why people like it, because if it's structured the right way, there's no ordinary compensation income for tax purposes at the time it's granted.
Right. Yeah.
And any future distributions are all taxed as capital gains. So people like that approach. But they clearly have some value, right? You can't just say that just because they're kind of, quote, at the money, there's no, if the company liquidated tomorrow, they wouldn't get anything. The tax rules may say there's no taxable compensation at that moment, but that doesn't mean there's not fair value for it. Mm-hmm. But because these are non-traditional arrangements and they can be structured in a variety of different ways, they certainly don't look like your typical stock or stock option awards that's covered in the literature for stock comp awards. So there's always been a lot of complexity in determining whether these profits interest awards should be accounted for as stock comp under ASC 718 or more like just a cash bonus or profit sharing arrangement under that guidance, which is ASC 710. And so there is some resulting diversity in practice here, although large firms all have some interpretive guidance in our guides that help you.
Do they all agree?
Through. I think, it's all very judgmental.
Right.
But they all kind of have similar factors to think about. But the decisions are still hard when you kind of think about all the factors.
Yeah.
So we all, I think, agree on the approach. It's just that the judgments are still tricky with all the different facts and circumstances. But while I think all the large firms have that, not every organization is as familiar with them, with that framework that's out there. Right? Not everyone is looking at those. So this was something that was initially identified and discussed by the FASB's Private Company Council as sort of maybe a way to help provide some input and feedback for them. Because typically these are issued by private companies. But ultimately when the FASB decided to take on the project and issue some guidance, they ultimately made it applicable to all companies because many of the entities that issue these arrangements ultimately seek to go public. So it's not limited to companies that are remaining private forever.
So in a nutshell, would you say that profits interest awards, since tied to an entity's future profits, are more common in private companies, while the stock appreciation rights, since tied to the stock price, are mostly used by public companies? I mean, is that the trend, or
it is, and it's not just whether it's private or public,
Right.
I mean, obviously it's a little bit easier in a public company
Yeah.
to come
Yeah,
up with
correct.
a stock price,
Yeah.
but you can always go value the stock. But it's more that these profits interests show up in LLCs.
Right.
Whereas a stock
And I think that's
appreciation right
helpful.
tends
Yeah.
to show up more in a C corp.
In a C corp. Yeah, that makes
I mean,
sense.
it's not limited. That's an overgeneralization, but
Yeah.
these profits interests tend to be in these other kind of alternative structures.
Yeah. So what did the FASB decide?
So what they ended up doing, it's kind of an interesting standard in that the FASB really didn't change any guidance here. What they really just trying to do was to add a bit of a roadmap by making it clear to everybody that you have to run these profits interests through the overall model, the scoping model, to determine if they're in the scope of the stock comp literature or not. And what they did is they provided 4 examples of various fact patterns that kind of walk through the analysis and come to a conclusion and say these are, so a couple of them they say they are in the scope of the stock comp literature, and a couple of them they say they aren't in the scope of the stock comp literature. But of course, these are more endpoint kind of examples, or they're a bit more obviously one or the other. But with everything we all run into, and our listeners all run into, the hard judgments are the ones in the middle. So there's still a lot of judgment to apply here. Now, it's true that this will help you figure out if you're in the scope of 718 or not, the stock comp literature. But if it is in the scope of that literature, you still have to run it through the rest of the model to figure out if it's equity or liability classified. Whether you're in, just because you're in 718 doesn't mean it still may not be a liability award if you meet the criteria for that. It's just, are you in that model in the first place, or are you more just in a bonus comp type model?
Yeah, I think that's very important points there, and important for our listeners to understand that the accounting model isn't necessarily changing here. So once you determine which guidance you're in the scope of, it's still necessary to kind of go through the corresponding accounting model in an appropriate manner. So whether that's ASC 718 or ASC 710. Can you give us an overview of the effective date of this one and what resources are available to our listeners?
Yeah. So for this one, for public business entities, it's effective for calendar 2025. So it's annual periods beginning after December 15th, 2024. So calendar 25 for those companies. And then for all other entities, for private companies, let's say it's a year later. So annual periods beginning after December 15th, 2025, so calendar 26. You can adopt it early, and you can either adopt it prospectively just to new awards that are granted or modified after the effective date, the day you adopt it, or retrospectively to all awards that have previously been granted, and you'd have to go back in that case and recast all the periods presented. Now, that being said, we don't really think there'll be that much of an impact, at least for our clients, because the standard's largely consistent with the interpretive guidance we had before. But since it's the first time there's been something about these kinds of awards in the authoritative guidance, if you have them, it's certainly worth taking a look.
Yeah, definitely.
And in terms of where we have some guidance around it, we included some discussion of this new guidance in Chapter 6 of our stock-based compensation guide, and there's a whole section in there about awards issued by pass-through entities, kind of all those factors we were talking about before.
Yeah, one thing that resonated with me, Jay, as you were kind of going through the discussion on this one, is just the importance of just not simply looking at what something's titled or called. You really got to look at the structure of these awards and understand the nuances, and really important to not just gloss over it and assume, this doesn't apply to us because we don't issue these because you call them something different. So I think it's definitely a good topic. We'll finish the podcast with one last standard, and I think this one's a unique one, right? Because it's been in effect for public business entities in calendar 2024, still on the horizon for 2025 for non-public entities. So it's also got the most complicated sounding name, and I think when I read it, I'm like, this has been discussed as PAM. And so it's that's ASU 2023-01, which is accounting for investments in tax credit structures using the proportional amortization method. So that's the PAM. Where the PAM comes in, I know it's a mouthful. Jay, can you give us some clarity on this one?
Sure. Well, I'll try here anyways. It's definitely, this one needs a little background to get into before getting into the accounting, because it's about the unique accounting for a particular type of investment structure out there. So this is all about taxes, tax credits. So the tax code allows for a variety of tax credits to incentivize certain types of investments and development. So think of things like low-income housing projects or rehabilitating historic structures or renewable energy projects like solar and wind or things like that. So there's a lot of different kinds of credits out there. Obviously, the IRA Act that's been out for a little bit of time created even more of them. So there's a lot of this stuff out there. And developers and operators of these projects, who would be the ones to get the credits through the projects, they may not generate enough taxable income to benefit from these credits. So as a result, over the years, various investment structures have been developed that involved operating the project using basically a specially created legal entity that's a pass-through entity for tax purposes, and then investors can come in and invest in the equity of that pass-through entity and get the tax credits as part of their return.
Got it. So the investors provide the capital for these developments because they're the ones that can actually use the tax credits. How can I get my hands on that? How can I use those tax credits myself?
Right.
It's obviously, going to be, cheaper financing for the developers than just obviously going to the bank and getting loans or some sort of line of credit. Any other thoughts there?
Yeah, no, I mean, that's exactly right. That investors basically are putting up capital for these developments, and instead of getting cash back as return of that money, they're getting the tax credits, and they run their economics and decide that that's a good investment. And especially for financial institutions, there's often community reinvestment requirements, right? They get some good positive benefit from their regulators for investing in these kinds of projects because they're often in economically challenged areas, or they're just good for the public interest. Public interest, right? And
absolutely.
There's a lot of motivations to invest in it, both financial and non-financial. But when you invest in these types of things, because they're investments in partnerships and things like that, they typically would qualify under general GAAP for the equity method of accounting under ASC 323 for the equity method, because they're pass-through entities with capital accounts and they have more than a minor interest in them, and the general perspective is those would be equity method investments. But for the most part, what you get here as an investor isn't a typical cash return, right? It's all these tax credits and tax losses, like from depreciation on the assets, that you can use on your tax return to reduce your taxes. But that creates an interesting disconnect in the income statement, because all those tax benefits go through your tax line. So your tax expense line is benefited by all those credits and deductions. But then when you recognize the cost of the investment over time, that's going through pre-tax income. So you have this mismatch between pre-tax and tax. And so some special accounting called PAM, or proportional amortization method, was developed years ago, decades ago, to help address that. But from a scope perspective, because that's what they were dealing with at the time, that guidance can only or could only be applied to investments in low-income housing tax credit projects, nothing else. Didn't go beyond that. And what the PAM method lets you do is it lets you amortize the cost of the investment that you made against the tax line as you recognize the tax benefits, kind of proportionately. As you're recognizing those tax benefits, you proportionally recognize the cost of your investment in the same place, so that the total impact of it all ends up in the tax line in the income statement. So it's a little bit easier to kind of see it match up a little better. But as I'd said, that can only scope-wise be applied to low-income housing tax credits, even though there's a bunch of other credit structures out there, like the solar and the wind and the other ones. And even though, the thought was, well, maybe those have some similar perspectives because of the scoping of it, those couldn't apply this. So those had to follow that sort of split presentation model where you'd end up with tax benefits down below the line and costs up above the line, and that would distort your effective tax rate and make it hard for investors to really understand things. So now finally coming to the new guidance. So the new ASU, or newer ASU, I guess at this point, expanded the scope of PAM. So it took the shackles off. It isn't limited to low-income housing tax projects. It allows it for the use of any investments in tax credit structures, as long as the investments are made primarily for the purpose of receiving income tax benefits, because this is special accounting. Right. So you should only get this in special circumstances, and it has to meet that goal as well as a number of other defined criteria that's in the guidance.
So it definitely sounds like it was a welcome change for investors. Certainly a beneficial outcome of the new guidance, and allows more investors to get that preferred net presentation of the tax expense line item in the income statement. I think it certainly simplifies the reporting there. I imagine, though, that it will be important to assess the various investments you have when trying to figure out whether you can apply PAM, though, right?
Right. No, that's definitely true because, well, you're absolutely right that it expands it and maybe makes it beneficial for people to use.
Yeah.
It's not that easy to end up qualifying, I would say, still, with the criteria that are out there. So what the guidance says is that you get to make a policy election to try to apply PAM on what the guidance calls a tax credit program by tax credit program basis. So you don't have to apply PAM or try to apply PAM to everything. You could say, well, for solar projects, I'm going to try, but for wind projects, I'm not. Right? Maybe it's just you realize that it'll be tough for it because you still have to go through. Even if you say I'm electing to try to apply PAM, you still have to go through each individial investment to figure out if it meets all of these defined criteria that are in the guidance. And those were tweaked a little bit, but similar to what they were before. And some of those were quantitative tests. So like one requirement is that you have to generate tax benefits that are at least equal to your investment. So you're recovering at least 100% of your investment through tax benefits. And then even beyond that, there's one of the other requirements is that substantially all, more air quotes, of the benefits that you expect to get back, all the money, the value you expect to get back, that substantially all of them have to come through income tax credits and other income tax benefits like depreciation, as opposed to cash flows from operations of the project or the sale of the investment at the time that you get out of it, or things like that. You get to do that on a discounted present value basis because a lot of times the credits are front loaded and the cash is back loaded, but you still have to meet this sort of substantially all test. And generally in the accounting world, that's thought to be 90% or more.
Yep.
So it can be hard to do that in a number of the structures that are out there, just the economics of the structures. And then along with the quantitative tests, there's also some qualitative ones, including one that has become a little bit sticky at times in our experience.
Like anything with qualitative.
Anything with qualitative.
Factors, right?
But one of them says that you as the investor in these projects, if you want to apply PAM, you cannot have the ability to exercise significant influence over the operations of the project, like a traditional equity method investment. The thought is that if you're applying PAM, you're just supposed to be a passive investor for tax credits, not an active owner-operator looking to maximize return. Right? Again, this is an exception model. And so most equity method investments where you're perhaps trying to maximize your return, which is what all investments you're trying to do, you can't get the special accounting. You got to just be a passive investor for tax credits. And what we found is it can be a little challenging because as we went through the implementation of this with our clients, a lot of the structures that are out there in these other tax credit areas, at least the existing ones, gave the investors a bunch of consent rights. And so you have to evaluate those pretty carefully to figure out, do they give you influence over the operating decisions that are being made, or are they just some, I'll call it protective rights on significant events for at the end of the life of the project. But we found that there were a lot of consent rights out there in the world, and so this one can turn out to be a little tricky as well. So because it can be hard to meet all the criteria, especially for some of the structures that are used in practice today, that's why the guidance gave you this election to make, that you could just decide that, I'm not even going to bother going through the process of trying to establish controls and figure out, does this particular investment meet it or does it not meet it, and just say, I'm not going to even try to apply PAM to these investments, this category, but I will try to apply them to this other category. That's why the guidance kind of gives you this choice. On the disclosure side, which maybe is a helpful element of this as well, is there are a bunch of enhanced disclosure requirements to try to better explain how much the tax benefits are each period and where everything is being presented in the income statement, and the balance sheet, the statement of cash flows, to help investors be able to better understand how these things are really running through your accounts and affecting things like your effective tax rate. And what's interesting is those are required even if you don't end up meeting the criteria to qualify for PAM, but they're part of a tax credit program that you had been attempting to try to apply PAM to, you still have to make those same disclosures, whether you're in PAM or not.
Yeah.
Just if you've elected in for a particular tax credit category, you have to make the disclosures for all of them here.
Yeah, I mean, that's very interesting to me, right? Like it's just thinking about scope, right? And you've obviously made a number of points on scope. Definitely going to be important to understand the nature of these tax credit programs and how they meet or don't meet the PAM criteria, because of what you laid out there with respect to the disclosure requirements that they apply more broadly than just the investments that qualify for PAM. Jay, anything else you want to add on that before I ask you about just, what's the timing on this one? When is the standard effective? Where can our listeners get more information?
Yeah, maybe I would add that perhaps because of the IRA and the broadening of the applicability of the credits, and more of them being out there, and just sort of a growing interest in, we'll call it
doing good deeds, right?
Doing good deeds,
yeah.
right?
Yeah.
In the world that we've, while historically the investors in these types of projects tended to be financial institutions and insurance companies and the like, but we have started to see more corporate entities. I'll use that phrase, expressing interest in investing in these for the reasons you said. And so that's, therefore introducing, the notion to a lot of entities that just aren't as familiar with this. And a lot of times too, the banks are offering to be middlemen and structure these types of investments for corporates. And so some structures are evolving a little bit, and there's just more players now that aren't as familiar with these types of structures or the guidance. So it's good guidance to take a look through if you're interested in pursuing these. And then moving on to your question there as to when is it effective and how is it effective? It's a little more complicated here as well, like with everything.
Why can't they just be simple like they did?
Like with joint ventures, right?
Exactly.
Everyone just adopts it together. So as you said, this one's actually already been in effect for public companies for 2024. But for all other entities, it's now going to be effective this year in 2025. Right. So annual periods beginning after December 15th, 2024. So basically calendar 25 companies will have to apply it now. Here, the transition's a little complex. Most of the provisions, you get to choose. You either get to apply it on a full retrospective basis or what the FASB calls a modified retrospective basis. Now, full retrospective means you go back and for all the years in your financial statements, you view it as if you've always been applying this guidance. So you show all your years on a consistent basis, but that means you have to go back to the first year, what you presented, figure out all the investments that would and wouldn't qualify, recalculate what all the amounts would be.
That's not a lot of work.
Figure out the cumulative effect, all that good stuff, and do that and run that through all the years.
Yeah.
Modified retrospective means doing all that, but just doing it in the year of adoption. Right. So the back years don't change, but the current year you're adopting it, you go through all that process to figure out what qualifies, what doesn't qualify. But if that's not complicated enough, there are a couple of other, we'll call it specific transition provisions for investments in low-income housing projects that aren't accounted for under PAM that you can apply prospectively if you want. But there's a lot of nitty-gritty detail that I don't think we need to get into here. But if you have that, you can definitely read more about that in our guidance. And that guidance is actually, we just recently repackaged some of our guidance in our income taxes guide to better talk about all aspects of tax credits, both this investments in these credit structures, as well as just other tax credits that you might obtain in your life cycle. And so that's now all in Chapter 18. It's a brand new Chapter 18 of our income taxes guide that covers all of it. And like some of the other ones, we still have an in-depth out there about this new standard that was originally put out in 2023, although we updated it in 2024 for some new developments as well.
No, it'll be interesting, right, to see kind of what happens anyway in 2025 with respect to taxes, right? Because that obviously be a heavy focus of this Trump administration and Capitol Hill. Well, Jay, that was great. We did it in under an hour, which I think is very impressive. With a lot of topics that we covered. Really appreciate you taking the time and all the insights you shared. And you definitely showed why you are my go-to guy, everyone's go-to guy for so many different topical areas. Appreciate your time.
Sure. Thanks for having me here.
Thank you.
That's our show for today. Tune in next week for more fresh episodes. So that you never miss any of our audio content, follow the PwC Accounting Podcast wherever you listen to your podcasts. And to stay up to date on all our latest accounting and reporting news, sign up for our newsletter at viewpoint.pwc.com. From Thought Leadership at PwC, I'm Heather Horn. Thanks for tuning in.
This podcast is brought to you by PwC, all rights reserved. PwC refers to the U.S. member firm or one of its subsidiaries or affiliates, and they sometimes refer to the PwC network. Each member firm is a separate legal entity. Please see www.pwc.com/structure for further details. This podcast is for general information purposes only and should not be used as a substitute for consultation with professional advisors, including accountants and lawyers.